Hello everyone, today we will be covering Chapter 1, which is titled An Introduction to Corporate Finance. So before we jump into today's discussion, I just want to make sure everyone is aware that in addition to this PowerPoint in which you can follow along and take notes, there also is a chapter outline located on Blackboard, so that is something that you may want to locate and work through as we go through today's chapter. It may help with keeping everything organized. So today, as we cover Chapter 1, our learning objectives, first of all, are to define the basic types of financial management decisions and what is the role of the financial manager within these decisions. 2, explain the goal of financial management. 3, articulate the financial implications of the different forms of business organizations. And lastly, be able to explain the conflicts of interest that can arise between managers and owners. So before we really jump into Chapter 1 here, I do want to break down the different areas of finance and kind of explain where does this course fall when we talk about the different areas of finance. So there are 4 basic areas of finance. The first area of finance is what this course is titled, and it is corporate finance. Corporate finance is really just basically business finance, and so the ideas and the principles that we cover in this class are applicable across all the different various areas of finance and beyond. So what we cover in this course, although it's titled corporate finance, you can really think of this course as being just simply business finance. What we cover you will see in any type of business and deals with all types of areas of finance. The second category would be investments. Investments deal mostly with financial assets, so we're talking about stocks and bonds. We do talk about stocks and bonds later in the semester. Some important questions that come about when you are discussing investments would be, what determines the price of these different securities? What are the risks and what are the rewards of the different assets? And how do I allocate these assets best? But that is the second area of finance, and it is investments. The third area would be financial institutions. So what are financial institutions? Well, first of all, financial institutions are businesses that deal primarily in financial matters. Some examples would be banks, so talking about commercial and investment banks, credit unions, savings and loans banks. We also have insurance companies. So they ask the question about, is a particular risk suitable for insuring and what should be the premium? And then we also have brokerage firms. Brokerage firms simply buy and sell securities for clients and for their own accounts. But that is our third area of finance. And then the fourth area of finance is not really its own separate area. Rather, it is a form of finance that specializes within one of these 3 areas, except it has international aspects. And that fourth area of finance is simply international finance. So as I mentioned, it's not really its own separate area, but it's more so one of the 3 previous areas, with just focusing on those 3 areas with international aspects. But as I mentioned, our course is corporate finance, which can be thought of as business finance, and that's what this course will be covering. So now we will move forward and dive into Chapter 1. And the first thing that we're going to talk about is the financial manager. So the financial manager is the individual that is responsible for the financial health of an organization. This financial manager tries to answer 3 main questions. The first question deals with capital budgeting. So with capital budgeting, this first question deals with long-term investments. So this is the process of planning and managing a firm's long-term investments. If you think about long-term investments, you can consider these as your fixed assets. So things like which buildings you should build, what type of machinery should you have, what type of equipment should you have. These are your capital budgeting decisions. You can also think of, should a company open up a new store? That is a capital budgeting decision because it is a long-term investment or a long-term investment. When you are considering these capital budgeting decisions, you are trying to identify opportunities that are worth more than they cost, right? So essentially what you're thinking is the cash flows that these assets are generating exceed the cost of the particular asset. And it's not just about the actual cash flow amount. It's also about when will you receive the cash flow and how likely are you to receive it. So with cash flows, there are 3 characteristics that you always must keep in mind. The size of the cash flow, which is simply the amount, the timing of the cash flow, which is when am I expected to receive this cash flow? Tomorrow, 1 year from now, 10 years from now. We'll talk about the concept of time value of money and how that's important on when you actually receive cash flows. We'll talk about that later here in the semester. And then also the riskiness of the cash flow. So what is the possibility that I actually receive that cash flow versus the possibility that I don't receive that cash flow? So this is something that will be discussed multiple times throughout the semester. Cash flows, understand that there are 3 characteristics: the size, the timing, and the riskiness. But the first decision that the financial manager tries to answer deals with capital budgeting. This is just a fancy terminology for a long-term investment. So these are your fixed asset decisions. The second question deals with the mixture of debt and equity that is maintained by the firm. So basically, what is the specific mix of long-term debt and equity that is used to finance the operations? So in our definition here on the PowerPoint, it says the mixture of debt and equity. Specifically, we're focusing more on long-term debt and equity. So when we are dealing with capital structure, it's just how do you fund your assets? Think to your balance sheet. You have your assets on your left-hand side, and then you have your liabilities and stockholders' equity. That is simply how you're funding those assets, how you're purchasing those assets. What is the mixture or the breakdown of debt versus equity? When you are thinking about capital structure, there are 2 main concerns. How much do I borrow? And also, what are the least expensive sources of these funds? So how much should I borrow versus bringing in other owners, so raising funds in the form of equity. But these are capital structure decisions. So we have capital budgeting, your long-term investments. Capital structure, how do I fund these decisions? And then your third decision deals with working capital management. So working capital, you can think about this in terms of those types of assets that are working on a day-to-day basis. Working capital management deals with your short-term assets and your short-term liabilities. So this is focusing on your current assets and your current liabilities. So for example, some different decisions, if you think back to your balance sheet on some different current assets and current liabilities, how much cash or inventory should I have on hand? Should we sell on credit? How will we obtain short-term financing? These are some decisions that deal with working capital management. So capital budgeting, long-term investments, capital structure, how do I fund these investments? What is my breakdown of debt versus equity? And then also working capital, your short-term. Just want to emphasize something here. This is why with capital structure, we're focusing on long-term debt, because your short-term debt is focused on with your working capital management decisions. So those are our 3 main decisions that the financial manager is trying to answer. As we work through this semester, you'll realize that we discuss all 3 of these decisions throughout the semester. So the financial manager, the top financial manager within a firm is usually the CFO, your chief financial officer. So they are trying to answer these three questions. They coordinate the activities of the treasurer and the controller. Well, who is the treasurer and the controller? The treasurer oversees cash management, credit management, capital expenditures, and financial planning. What you hopefully can see here is we're focusing, if you look at these different duties of the treasurer, cash management, cash is a current asset, so that would be a working capital decision. Credit management deals with your capital structure, so how you're funding on your debt obligations, so that would be a capital structure, or also a working capital management decision. Capital expenditures is another name for capital budgeting, and financial planning. So the key takeaway here with the treasurer is basically the treasurer is helping answer those 3 questions presented on the previous slide: capital budgeting, capital structure, and working capital management. So our study in this course is really focusing on the duties of the treasurer. The controller, they oversee taxes, cost accounting, financial accounting, and data processing. So they deal more with the accounting side of things. The key takeaway from this slide is that the top financial manager is often the CFO, and the CFO is trying to answer those 3 questions mentioned previously, and they do so with the help of one key position, which is the treasurer. So before we move into some different forms of business, let's just look at a simplified corporate organization chart. One thing to keep in mind here is that up at the top, we have our board of directors. It's important to realize that when we are dealing with corporations, and we'll discuss and get into more detail on this as we work through the semester, corporations are owned by shareholders. Shareholders elect the board of directors, and the board of directors hire the management positions such as the CEO and the COO. So there is a separation between your shareholders, who are the owners of the corporation, and then the managers, the CEO, the COO, that manage the corporation. So we'll discuss that more here later in this particular chapter. But this is just a simplified organization chart where we have our board of directors up top. They are elected by the shareholders. They hire the different management positions such as the CEO, the COO, and we are focusing here on the financial manager, which could be the vice president of finance, the CFO, and the different individuals that report to that particular manager that is trying to answer the 3 questions mentioned previously in today's discussion. So, moving forward, we are now going to discuss the different forms of business organizations. So first of all, there are 3 major forms in the United States. There are sole proprietorships, partnerships, and corporations. So we'll first discuss the definition of these 3 major forms, and then we'll talk about the advantages and the disadvantages of each before we really dive into a focus for the rest of the semester on corporations. So the first is a sole proprietorship. A sole proprietorship is a business that is owned by a single individual. So this is most businesses, or roughly 75% of all businesses are sole proprietorship. So there are more sole proprietorships than any other type of business. Oftentimes, even large corporations will start off as sole proprietorships. Partnerships are a business that are formed by 2 or more individuals or entities. They can be a general partnership or a limited partnership. We'll talk about the differences here shortly. And then we have corporations. A corporation is a business that is created as a distinct legal entity composed of 1 or more individuals or entities. So these are the 3 major forms. Let's jump into the advantages and the disadvantages of each, and I'll also give some more details on the different forms here upcoming. So first, a sole proprietorship. As I mentioned, approximately 75% of all businesses are sole proprietorships. What are the advantages of a sole proprietorship? First of all, they are easiest to start. One thing being you don't have to register with the state. You may have to register in your city, but not always, but they are easiest to start, less obligations to start a sole proprietorship. They are also the least regulated of our 3 major forms of business. The single owner keeps all of the profits, so you are the only owner, you keep all the profits, and you are taxed only once as personal income. So sole proprietorships are what are called a pass-through entity, so your profits pass through the actual business to the individual, and you are taxed on those profits only once as personal income. Some disadvantages is it is limited to the life of the owner. So if I am the owner of a sole proprietorship and I pass away, my sole proprietorship dissolves. The equity capital is limited to the owner's personal wealth. All this means equity is just the owner's capital. So the equity is limited to whatever the owner can actually obtain. And then you have unlimited liability. With unlimited liability, this means that in the event of some type of financial claim, they can come over your personal assets for payment. So if you owe $1 million, but the business is only worth $500,000, the business assets are only worth $500,000, they're not going to stop at just the business assets. They're going to come after your home. They're going to come after your car. They're going to come after your personal assets for payment. And then another disadvantage of sole proprietorships is it is difficult to sell your ownership interest. Why is it difficult? Because it would require the sale of the entire business to a new owner. So with these sole proprietorships, as I mentioned, most businesses in the United States are sole proprietorships. Oftentimes, larger businesses do start off as sole proprietorships before advancing and taking advantage of some of the different forms that I'll discuss here upcoming. But one example of a sole proprietorship that is now a corporation would be eBay. So eBay used to be called AuctionWeb. So it was called AuctionWeb in 1995. It decided to convert into a corporation status and went public then in 1998. But that is an example of a company that started off as a sole proprietorship and eventually took advantage of the corporate status and the advantages that a corporation can bring. So that's our sole proprietorship. The second business is a partnership. Sole proprietorships make up roughly 75% of all businesses. Partnerships make up approximately 10% of all businesses. So these are similar to a proprietorship, except they have 2 or more owners. So that would be one of the advantages. Why do you think that it would be an advantage to have 2 or more owners? One advantage of that is more expertise. One owner could be their specialty could be in marketing, the other could be in finance, but you have more expertise when you have 2 or more owners. Also, there's more capital available since you have more individuals being able to raise that capital. They are still relatively easy to start. You do have to create a partnership agreement, but they still are relatively easy to start. So the partnership agreement will outline the roles of the different partners. Once again, partnerships are pass-through entities, so your income is taxed only once as personal income. Disadvantages: you do possibly have unlimited liability, and it depends on what type of partnership you have created. So there are 2 different types of partnerships. There is a general partnership and a limited partnership. With a general partnership, you share all the gains and you share all the losses, and you have unlimited liability for the debts. So in this general partnership, you have unlimited liability even if you did not know about the debts. So even if your partner went and got into some type of debt obligation and you didn't know about it, you are still liable for that debt obligation if you have a general partnership. Well, how do you know if you're in a general partnership? The way that your partnership is set up is created when you create that partnership agreement. So the way that your gains and your losses are going to be divided is all going to be described when you create that partnership agreement. The one way that you can have limited liability is if you enter into a limited partnership and you are the limited partner. Well, a limited partnership is when one or more of your general partners will run the business, and then you'll have a limited partner. The one that runs the business has unlimited liability. The limited partner is only liable for what that individual contributes. The key with a limited partnership, though, is that you cannot be active in management. An example of a limited partnership would be real estate ventures. So limited partnerships, you have a general partner and you have a limited partner. The general partner has unlimited liability. The limited partner is only liable for the amount that they put in. However, they cannot be active in the day-to-day operations. Also with partnerships, the partnership will dissolve when one partner dies or wishes to sell. And then it's also difficult to transfer ownership. Why is it difficult to transfer ownership? If you're trying to transfer ownership, you would have to form a new partnership with a new individual if you're trying to transfer your ownership. So one last thing with partnerships, it is also difficult to grow a partnership because your equity capital, so the amount of capital that you can raise, is limited with just to what the different partners can actually raise individually or together. So overall, there are 3 main disadvantages of sole proprietorships and partnerships in comparison to our third form. The 3 main disadvantages are: 1, you have this unlimited liability. So they can come after your personal assets in the event of some type of claim. 2, you have a limited lifespan. So that's focusing here on the second bullet, which was also seen in the sole proprietorships advantages and disadvantages. And then it's also difficult to transfer ownership. So 3 main disadvantages of sole proprietorships and partnerships: unlimited liability, limited lifespan, and also difficulty with transferring ownership. This is where a corporation comes into play. So with a corporation, this is your most important form of business in terms of size. If we had 75% of all businesses being sole proprietorships, partnerships equaling 10%, approximately 15%, these are all approximate values. It's like 13%, I believe, of all businesses are corporations. But this is your most important form of business in terms of size. So corporations are considered their own legal person, their own legal entity, which is separate and distinct from its owners. So oftentimes these owners are your stockholders. So as a result of them being their own separate legal entity, they have the same rights as an individual would from the Bill of Rights or through the Bill of Rights. So they have the right to due process. A corporation has the right to due process. They have the right against unreasonable search and seizure. But that's what's unique about a corporation, is that it is its own separate legal entity, separate from its shareholders or separate from its owners. So what are the advantages and the disadvantages of a corporation? One last thing before I move into the advantages and the disadvantages. Corporations are thought of as a creature of state. So they are a creature of whichever state that they are incorporated in. With a corporation, the first advantage is limited liability. So with limited liability, since the corporation is considered its own separate legal entity, separate from its owners, as a owner in a corporation, you are only liable for the amount that you have invested in that particular corporation. So if you are a shareholder of Apple and Apple is getting sued or has claims against their assets, you're only you're only liable for the amount that you have invested. You cannot lose more than what you have invested in the company. They can't come after your personal assets. Corporations also have an unlimited lifespan. So when you create a corporation, you create what is called an Articles of Incorporation, and within that Articles of Incorporation, you set what your lifespan is, and you can technically put that your lifespan is unlimited. So corporations eliminate one of those disadvantages of sole proprietorships and partnerships in the fact that a corporation has an unlimited lifespan. There is also this advantage of a separation of ownership and management. So as an owner, I can diversify my investments into multiple companies in which I may not have prior knowledge or have expertise in actually running those particular companies. So I can be a shareholder in Apple and know zero about electronics due to this corporation being its own separate legal entity where there is this separation of ownership and management. Also, the transfer of ownership is easy due to financial markets. So if I want to share sell one of my shares of a publicly traded company, this transfer of ownership is made easy or easier by the financial markets, and we'll talk about financial markets here later in today's discussion. And as a result of these financial markets, it is easier to raise capital for these companies, whether it be in the form of new equity shares or in the form of debt by issuing bonds or other debt collateral or other debt obligations. Disadvantages. It is more complicated to start up than sole proprietorships and partnerships. So as I mentioned, with a corporation, you need to file an Articles of Incorporation or a charter, and you need to prepare a set of bylaws. So an Articles of Incorporation simply states the name of your corporation, what is your intended lifespan. So as I mentioned, you could have an unlimited lifespan. What is your business purpose? What are the number of shares that are going to be issued if you are going to be publicly traded? But that is what is included in a Articles of Incorporation. Bylaws are something else that need to be created. These are simply rules that describe how the corporation is going to regulate its own existence. But once again, more documentation that needs to be created with the corporation, so it is more complicated. And then we also see that we have a separation of ownership and management. An advantage and also a disadvantage. When you have this separation of ownership and management, you could have what is called an agency problem. We'll talk about what an agency problem is here on the following slide or on an upcoming slide. But realize that this separation of ownership and management can be both an advantage and a disadvantage. And then another big disadvantage of a corporation is that you have double taxation. So with sole proprietorships and partnerships, those businesses were pass-through entities, so the income was passed through the business and taxed as personal income. Since the corporation is its own separate legal entity, you experience double taxation. So the income for the corporation is taxed at the corporate tax rate, and then as an owner, if I receive a dividend, that dividend is taxed at the personal tax rate. So you have your profits are taxed twice, both at the corporate level and also at the individual level when you are an owner in a corporation. You also have hybrid forms. So hybrid forms of business, before moving into the hybrid forms, that concludes our three main areas: sole proprietorships, partnerships, and corporations, where you have these you have the advantages and disadvantages of each. There are some other forms of business structure, and this is where we move into limited liability companies. These are hybrid forms. You have LLCs. There are also LLPs, which are limited liability partnerships. But these hybrid forms operate and are taxed like a partnership, so they are pass-through entities and you're taxed only once at the personal level, but they still retain the limited liability for owners. So you do not have the unlimited liability where they're coming after your personal assets. You're only liable for the amount that you have invested. So essentially, they combine the best of both worlds of a partnership and a corporation. So they are a hybrid of the two. And each state does have differing definitions for LLCs. So not every company can apply to be a limited liability company. So different states have different definitions. What's key is how does the IRS treat you? So are you going to be taxed as a pass-through entity, or are you going to have the double taxation of a corporation? It is important to realize that one of the areas of finance was international finance. So international corporations may go by different names. So if you are working internationally for a firm, you may see different names for corporations. They may be called joint stock companies. They may be called public limited companies, or they may be called limited liability companies as well. But these are just some different names that international corporations may go by. So what should be the goal of any of these businesses? So we have these different forms of business: sole proprietorships, partnerships, corporations. What should be the goal of financial management when running or executing, conducting business for these three different forms? So what are some ideas as possible goals? Oftentimes, these are some different goals that come up in class. Well, first of all, let's just survive. Let's avoid financial distress and bankruptcy. Let's beat the competition. Let's maximize sales or market share. Let's minimize costs. Let's maximize profits. Let's maintain steady earnings growth. All of these are different goals, but what should be the actual goal? Let's talk about why some of these goals listed here on the slide are not proper goals of financial management. First of all, let's look at maximizing profits. Why not maximize profits? Well, first of all, this is not a precise goal. So, does this mean maximize profits this year? Does this mean maximize profits this quarter? There's a lot of ways that you can maximize profits, but it's not clear. You can maximize profits by decreasing inventory and cutting short-term costs, but this could hurt the firm down the road. A second one that I want to look at is minimizing costs. So why not just minimize costs? Well, minimizing costs could hurt the possibility of expansion down the road. So this could actually limit the possibilities of the firm. Why not maximize market share? Excuse me. Why not maximize market share? Well, you could sell your items for $1 and increase your market share, but you're not going to make any profits. So with all of these goals are not specific goals. So what should be the goal? The goal of financial management should be to maximize the current value per share of existing stock. So another way of looking at this is maximize shareholders' wealth. You will see this in a lot of literature that the goal of financial management should be to maximize shareholders' wealth or maximize stockholders' equity. And when I say stockholders' equity, it's important to realize that I'm not talking about the stockholders' equity on the books. I'm talking about the stockholders' equity in terms of a market value. Well, how do you look at the market value, the actual value of something? You would look at the value per share of the existing stock. So you may ask yourself, what do you do if the firm has no traded stock? So what if you're a sole proprietorship or a partnership? Well, that would mean that you want to maximize the market value, once again, the market value of the existing owner's equity. Now, when I'm saying maximize shareholders' wealth, basically what you're trying to do is you're trying to pick goods and services that are going to add value to the firm. The value of the firm is the present value of the future cash flows. So when analysts determine a value of a company's firm, you're going to hear them talk about their free cash flow and talking about the different cash flows that they're generating. When analysts consider the value of a firm, they consider the size and the timing and the riskiness of the cash flows. So once again, they're looking at cash flows and they're looking at what are the amounts, when are these cash flows occurring, and what is the riskiness of this particular business's operations. So what's key, another way that you can see maximizing shareholders' wealth is you can also look at this as a goal of maximize cash flows. So as we go through our discussion, or as you're going through any business, it should make sense. You want to maximize your wealth. Same with the corporation. How do you maximize wealth? You maximize the stock price. That's how the wealth of the owners is shown at a market value, is looking at the stock price. So does this mean that you should do anything and everything to maximize your stock price? Well, you still have to act ethically. So you still have to act ethically when you're conducting business. And as a result of a lot of corporate scandals that were in effect, the Sarbanes-Oxley Act was put into effect to fight some of this corporate fraud. So, what is the Sarbanes-Oxley Act? The Sarbanes-Oxley Act was driven by corporate scandals such as Enron, Tyco, WorldCom, Adelphia. If you've heard of any of these scandals, basically what was going on is there was misrepresentation of different values on their financial statements. So we needed something to be put into effect to help deal with this corporate accounting and financial fraud and help improve the reliability of the financial statement. So when an investor or a potential investor is looking at a company's balance sheet or income statement, they can be confident that what they're looking at are true values and accurate values. So what the Sarbanes-Oxley Act was intended to do was to strengthen protection against accounting fraud and financial malpractice. So some examples of what the Sarbanes-Oxley Act instituted were longer jail sentences. You could lose your position, obviously, but it wasn't just a slap on the wrist. There was a lot more repercussions if you were caught misrepresenting values on your financial statements. Something else that they did, that the Sarbanes-Oxley Act did, is that they recommended a separation of the chair of the board of directors and your CEO, so that you didn't have the incentives to really profit personally by this fraud and financial malpractice. But with the Sarbanes-Oxley Act, the compliance was very costly, so it actually had an adverse effect. There were a lot of firms, a lot is a relative term. There was a good amount of firms that were driven to go public outside of the U.S. or go private, which is going dark. So basically, if you go public outside of the U.S., the Sarbanes-Oxley Act does not apply to you, so you don't have to follow their rules. So one of them being that you also had to have an external auditor audit your financial statements, so someone not associated with the firm. That's another thing that the Sarbanes-Oxley Act brought about. And then if you go dark, then you also don't have to comply with the Sarbanes-Oxley Act. And you can also save a lot of money if you are not if you do avoid having to go through the different steps that the Sarbanes-Oxley Act had. But this is something that is important. It was put into effect in 2002 as something to increase the validity and the reliability of the financial statements, so that as we look at these financial statements, we can be more assured that when we are looking at them, the values that we see are actually correct. So our next turn is to turn into the agency problem. So if you remember previously, we talked about the separation of ownership and management. Excuse me. The separation of ownership and management being an advantage and a disadvantage with corporations. With an agency problem, this is that separation of ownership and management. Well, what is it? An agency problem occurs when you have an agency relationship. So this exists when someone, the owner, the principal, hires someone else, the agent, to represent his or her best interest. So as you can see, the principal is the owner. The agent is hired to represent the best interests of the owner. Some examples would be, let's say you are the owner of a pizza shop and you hire a manager to run the store, or you are the owner of a car and you hire someone else to sell your car. Well, when you have this separation of ownership, for our example with corporations, owners would be the stockholders. The agents would be the managers, so CEO, CFO. Anytime you have an agency relationship, there's the possibility of an agency problem. So an agency problem is a fancy word for the possibility of a conflict of interest between the stockholders and the management of the firm. So for example, with my pizza example, let's say you are the owner and you want the pizza shop to stay open on Halloween weekend until 3 o'clock in the morning, and you hire a manager, and that manager wants to close down at 10 so they can enjoy the festivities. That is an agency problem, a conflict of interest. With the car example, let's say you are the owner and you hire somebody to sell your car for a set commission. If it's for a set commission, they don't have the incentive to try to get the best price possible. They just need to sell the car. So there is a conflict of interest. Anytime you have this conflict of interest, you could possibly have an agency cost. An agency cost is the costs of that conflict of interest between stockholders and management. So for the pizza problem, it would be the loss of sales by closing early as opposed to staying up by staying open. In the car example, it would be the loss of potential profit if they just sell the car for to the first buyer as opposed to trying to get the highest price possible. If we look at it more from a corporation point of view, let's say the CEO goes and eats $100 steak instead of eating at McDonald's. That's a cost where the owners would probably would probably like the cheaper food alternative, and the owner is getting something much more expensive. Obviously, that's a pretty small cost, but let's say you take a private jet to a conference as opposed to taking a commercial airline. That would be another agency cost, a conflict of interest between owners and management. So how do I align the goals, or what are a couple ways in which you can align the goals of shareholders and management? One would be managerial compensation. So with managerial compensation, you could tie the manager's compensation to some to financial performance. In particular, if the goal of financial management is to maximize share price, you could tie their compensation to the stock price. So they could buy the stock at a fixed price, and so they have the incentive to get that stock price as high as possible, so that they can maximize their gain as much as possible. Some other ways to align. So these are ways to align the goals of shareholders and management. Would be job prospects. Job prospects simply being that those that are most successful tend to are the ones that tend to get promoted. You also have the possibility of takeover if you do not align the goals. What's imperative with this, though, is that all the incentives, in particular with this managerial compensation one, is that these incentives need to be carefully structured so that the incentive actually ensures that they achieve the goal that they're going for. So with this agency problem, the agency problem is simply a separation of ownership and management, and a possible cost. The agency problem is a conflict of interest, and costs that come about are agency costs. You can align them through managerial compensation, corporate control, the possibility of being taken over, and there could also be proxy wars. So you don't want to have your shareholders try to get a proxy and get a new board of directors in there to hire new managers. So these are just some different ways or some different things that can happen in order to deal with these agency problems. So last up, as we go ahead and conclude Chapter 1 is talking about financial markets. So as we think back to our primary advantages of corporations in comparison to partnerships and sole proprietorships, primary advantages with corporations are that ownership can be easily transferred and that money can be raised more easily. Why is this so? It is so because of these financial markets. So financial markets are simply the arenas through which funds flow. And this is a chart that shows how the cash flows actually flow between the corporation and the financial markets. So first of all, in Part A here, the company is going to issue securities. So the firm issues securities, and they raise funds from the financial markets. The firm then will invest in assets. So these are your capital budgeting decisions. Once they invest in these assets, they are generating cash flows, which is Part C. And then after they are generating these cash flows, the government's going to go ahead and take their claim. And then the company has a decision to make. They are either going to reinvest the funds back into the company in the form of retained earnings, or they are going to pay it out in the form of dividends to their shareholders. So the companies have issued these securities. They have funds flowing from the financial markets to the company. The company purchases assets with these funds, which would be their capital budgeting decisions. Those funds or those assets generate cash flows. The company pays the government their take, and then they either reinvest it to grow organically, grow within, or pay those funds out in the form of dividends to their shareholders. So a little bit more with financial markets. Financial markets simply bring buyers and sellers together. So this is where you're buying equity securities, so stocks or bonds. This is why it's easier to raise capital, is because of these financial markets bringing buyers and sellers together. And then you can also transfer ownership much more easily in these financial markets. So last up with financial markets, there are two types of financial market transactions, and this depends on when the security is being issued or how it's being traded. With a primary market transaction, this is the original sale of the security by the corporation or by governments. So this is where you've heard the term an IPO. That is just one type of primary offering. So an IPO is an initial public offering. This is a public offer or an offering to the public. These companies must be registered with the SEC, the Securities and Exchange Commission, which can be costly. But there is another primary transaction that you may not be familiar with, which is a private placement. This is where you negotiate the sale involving a specific buyer. So oftentimes it's sold to large financial institutions, such as life insurance companies and mutual funds. But with a private placement, it is a primary transaction, but it does not have to be registered with the SEC. What's important to realize about the primary transaction is that the primary transactions are the transactions that actually impact the company or the government's cash balance. So in a primary market transaction, they are initially offering the security, and the funds that they receive go directly to them. On the other hand, then you also have these secondary market transactions, and a secondary market transaction is when securities are bought and sold after the original sale. So Apple has an initial offering of securities to the public. That is a primary market transaction. If I bought one of those and then traded to you the next day, that is a secondary market transaction. So secondary market transactions do not impact the cash balance of the particular company or government entity. So these occur on different exchanges such as NASDAQ or the New York Stock Exchange, but these secondary market transactions are what provide the means for transferring ownership. And there's two main types of markets. There is a dealer market and an auction market. With a dealer market, they generally buy and sell securities for themselves or out of their own inventory. Think of a used car dealer buying and selling out of their own inventory. So they make the money on the difference that they pay and the difference that they sell. So we'll talk about this more when we talk about bonds, but the way that you can think of a dealer market would be think of a car dealer buying and selling out of your own inventory. The number one dealer market is NASDAQ, the National Association of Security Dealers Automated Quotation System. So these transactions in a dealer market are called over-the-counter transactions. They're called over-the-counter transactions because they used to actually be physically, or they used to actually be sold over a physical counter. Now they are oftentimes linked electronically, but those are dealer market transactions. And then you also have auction market transactions. So with an auction market, this is where brokers and agents match buyers and sellers, but they don't actually own the commodity being traded. So think of a real estate agent. With an auction market, you'll have a physical location. The auctioneer will match buyers and sellers together. And the number one example of an auction market in the U.S. is the New York Stock Exchange. So there's two links embedded here within the PowerPoint if you want to just check out the NASDAQ and the New York Stock Exchange. Something to realize is that the NASDAQ has roughly 3 times the number of companies listed in comparison to the New York Stock Exchange, but the companies are much smaller in size and oftentimes trade much less actively. With the New York Stock Exchange, most large firms in the United States actually trade on the New York Stock Exchange. They account for the New York Stock Exchange accounts for more than 85% of all the shares traded in auction markets. So these are your financial markets types. These are types of transactions, and these are actually types. So types of transactions versus types of actual markets. And I apologize for my handwriting. Hopefully you can verbally, or you can hear it, me say it verbally. So that concludes chapter 1. I know that I've gone through a lot of material here. Hopefully going through the handout helped you focus on the main aspects. I try to provide a little bit of extra detail so that you have a little bit more of a firm understanding of things. But just going through the quick quiz, you should be able to answer these questions at the end of this chapter. First of all, what are the 3 types of financial management decisions, and what are they designed to answer? So we talked about capital budgeting decisions. Those are your long-term investments. Capital structures, your breakdown of long-term debt versus equity. So how do you fund those assets? And then working capital management decisions. Those are your day-to-day operations, your current assets and your current liabilities. What are the 3 major forms of business organizations? You have sole proprietorships, partnerships, and corporations. Know the advantages and the disadvantages of each. What is the goal of financial management? There's a lot of things that you can focus on, but the goal should be to maximize shareholders' wealth. And then what are agency problems? Agency problems are a conflict of interest between owners and managers. They occur when you have an agency relationship, a separation of owners and management. So why do they exist? Because of that separation. And then what is the difference between a primary market transaction and a secondary market transaction? The primary market transaction is the initial offering of the security. Secondary market transaction is the outstanding trades of that security. So that wraps up Chapter 1. Be sure to complete the Chapter 1 homework through Connect. If you have any questions about anything, don't hesitate to reach out. And I look forward to working with you here as we move into Chapter 2. Have a great rest of your day.